Good afternoon, everybody. Welcome to the TraderMerlin show. It is your, what day are we on now? It's Thursday. That's right. We're gonna have Bill Addiss on the program today in just a second. We will definitely get into the markets. As you guys probably saw, you have Google down 4% after hours, Amazon down 4% after hours, Apple down 4% after hours. So looking good for those who may have shorted today. I did buy 40 puts for April. We'll see if that pans out here on the triple Qs. We'll talk about that as we progress through the show today. I want to make sure we have some time to get to our guests and spend as much time as possible. But as usual, did I prepare everything as I thought? Yes, I did. Damn, I'm good. I'm good today. Our guest, no stranger to the program. I get him on about once a month. Very excited because I always learn something about the bond markets, about interest rates, and of course, with Jerome Powell's presentation that he gave yesterday in his speech at the press conference, cast a whole bunch of different perspectives on where this market may be headed. So I figured let's bring on Bill Addiss to talk about not only what the Jerome Powell said, but how that might impact the bond markets going forward. Mr. Addiss, how you doing today? Are you? Oh, hold on one second. This is going to drive me nuts, Bill, because I'm gonna feign conversation here. Our audio was working 100% perfectly until the show started, and now all of a sudden, I don't have your audio. So give me 2 seconds here as I try to capture your audio. We'll call that Zoom and see if this works. All right, say something for me. No. Did you switch something? Because now all of a sudden, I'm going to try this one last time here, and we will see if I can get this to work. I don't know why it does this every now and again. There you go, and hit this one.
I'll keep talking.
There you go. I see you, Bill. Okay, I can see your audio is popping now, but now I have to just wing it through today's show. So it'll be fun. Anyway, tell me how you doing, my friend. What's been going on?
I'm well. I appreciate the opportunity to catch up as we do every month, and this week being Fed week, it's a good time to talk.
There's always something interesting. Was there anything that stood out for you with regards to what Jerome Powell said yesterday? You know, he kept reiterating over and over and over again, saying ongoing increases are appropriate. You know, he wanted to like pound that into the audience, but it feels like they weren't even listening, right? They just kind of shunned that, and the markets took off and were ripping out there today. Was there anything groundbreaking from your perspective?
No, but I do think for those people who wanted to be a little bit more constructive to the market, you know, the comments that the policy statement that the Fed came out with at 2 o'clock was very stringent. You know, commitment to inflation, ongoing hikes, and so on. But when you get into the press conference, he did nuance it a little bit. You know, talking about how next meeting they'll do the surveys and maybe we can readjust the plot points, and he at least put some nuances that weren't quite as strident. And the equity market, I'm a bond guy, so I should keep quiet about equities, but I don't understand the equity market response. They're seeing an optimism that I just don't see.
Mm-hmm.
I mean, the Fed is committed to continuing to raise rates. Somehow that seems to get lost in the translation.
Yeah, interesting how these things do get lost in translation. I mean, it actually wasn't really lost in translation. It was just flat out, we're gonna see more rate hikes. I mean, he said it, like I said, over and over again in that speech. And you know, I kind of have this fear that the traders out there are looking at it going, well, you know, no big deal. He's already started to backpedal a little bit, and maybe it's a sign that things are looking much better. You know, he also pointed out multiple times saying interest rates, you know, talking about, inflation. That inflation was starting to look a little bit better, but I thought he said, the quote he used was, we need substantially more evidence in order to cut. And at this point, I think traders may have been rejoicing, saying, well, at least he's open to the idea. But I look at it as there's still a long way to go before we get to that point where he's cutting, right? We're probably going to get another 2 more increases of 25 basis points, a pause for a few months to see if things are in fact, taking effect. And then maybe some point down the road, probably next year, cutting. I don't see it happening this year.
And as you know, I'm very hard pressed to make prognostications going out 4 meetings into the future. You know, I really think the Fed doesn't know whether they're going to raise 25 or 50 next meeting. I mean, all of this is data determinant. Right. You know, I love the press and others who, you know, they want to prognosticate not just this meeting, next meeting, but the one after that, the one after that. It's, you know, once again, let's wait and see how this is going. We still don't know whether we're going into a recession or not. There's some pretty fundamental questions the economy has to answer here.
Wait, we're not going into a recession? Come on, say it ain't so. We're going, man.
It's a smooth landing. Come on, it's that ever elusive smooth landing.
Ever elusive smooth landing. Let's talk about some of the data points out there. The yield curve is obviously a pretty important topic for just about everybody that's involved in the markets, and we've seen the inversion of that yield curve. I guess get a little. It's flattened out. I'll say it's starting to look a little bit better. But I've got your charts up here of the yield curve. What's your thoughts on the way we're headed with regards to our yield curve?
The thing to continue to point out is, with the Fed's commitment to be raising short-term rates, and again, whether it's going to be 25, 2 times 25, 1 times 50, but with the Fed's commitment to raise short-term rates, we've seen some real pressure on long-term rates going down. So, thanks to the Fed over the last 24 hours, that inversion has steepened a little bit. But there's some real implications, and we had some further charts on this, to the commitment that the Fed has in raising short-term rates. I mean, just looking at the positive, all of us are starting to earn some, not attractive, but better than zero interest rates on our money market funds and short-term investments. Short rates have risen more dramatically than any other sector of the market. They're starting to get to almost, I dare say, at attractive levels. Unfortunately, that means the government is having to pay a boatload more on interest charges. And the Fed is also getting into a problem where they're having that inverted yield curve means that they too have to pay out a lot of interest. So you and I, as actual money market fund holders, are benefiting from this, but the Fed and the government are actually hurting from this. The Fed could be losing money this year. Oh God.
Yeah.
Oh no.
Yeah. How dare they lose? I have the chart up here for everybody. This is the 10 versus the 1 year, just to drive home the point of that inversion. And, we started to see it stabilize. You saw back in December of last year, the distance between the 10 and the 1 year was closing, right? The 10 year was falling. The 10 year was rising, which would stretch out that inversion. But then it dropped back down. And here we are at one and a quarter essentially. So 1.25 percentage points more if you hold a 1 year bond versus a 10 year. Kind of crazy to think that you get rewarded so much for the short term, but we really haven't seen this thing rally back up here. What is this? I guess the extent to which we continue to have this inversion. I brought up on the 10 versus the 2 year for our viewers a while back, and I'll show everybody here again just for reference. You notice that on this 10 versus the 2, going all the way back into the 80s, we've never been this extended with regards to inversion. Even back in the 2000, we were at about 50 basis points, meaning you got a half a percentage more for holding a 1 year or 2 year versus the 10. Back in 89, it was about 50 basis points as well, and here we are at almost 70 basis points, and it's been down there longer than any other time. Does this concern you, the length and time that we're down there, as far as how extended the inversion is?
Absolutely. And I have to say, I'm a bond guy. We've had this discussion, 40 years, 7 inverted yield curves that we've had. I've experienced 4 of them. No, the depth and the length of the inversion does scare me. I go back to 2019. I looked like an idiot when the yield curve went briefly inverted, as you can see back in 2019. And I said, okay, we're inverted. We're got to be going into a recession. And I looked like an idiot. I feel, unfortunately, the recession looms ahead and the bond market is predicting that. But I have to stress the dichotomy. That's certainly not what the equity market seems to be telling us in the last few days.
And that's it's funny, yeah. And I had to just jump in because I think that's the funny part. We felt this equity market put in a bottom and felt like it's starting to make some higher lows, and we've been focusing on this show like waiting for it to break through the higher highs. Here's your S&P on a weekly, everybody. Here's the Nasdaq, which is just really was smoking today, ripped through those highs in just this week alone, and. I'm questioning why. I look at this and go, that inverted yield curve is still so deep. That's certainly going to bring some pain. You brought up another interesting point in discussions just between you and I, which was, as these yields continue to get higher and raising the Fed's fund rate certainly has a direct impact on the overall yield. The higher that gets, the more expensive it is for our government. And we're already in a situation where we can't pay our debts. There's no way we can meet our financial obligations. And here we are letting that interest rate get higher and higher and higher, which means the cost of that debt that we already couldn't pay becomes even more unpayable. The dreaded default word is looming in the distance here with the debt ceiling and us unable to pay our debts. Does this play into this current discussion of rates increasing as well?
Absolutely. And it only exacerbates the problem even more so. So just for the moment, keeping the debt ceiling circular firing squad discussion off to the side for a moment. Just looking at the rise in interest rates, we've got now $30 trillion worth of debt outstanding. And a lot of that debt gets refinanced on a weekly basis as those treasuries keep maturing and we keep rolling them over. I mean, the Office of Management and Budget estimates that for every 1% rise in interest rates, it costs the US government another $285 billion for every 1% rise in interest rates. Well, last year, interest rates rose by not linear, but on average, just under 4%.
Yeah.
Well, that means that we added $1 trillion to our deficit.
Oh, no big deal, Bill. That's no biggie. Come on, $1 trillion. So what's that amongst friends?
There, it starts adding up eventually, right?
Well, and compounds, right?
Yeah, interest on our debt is the government's third largest expense after defense and infrastructure. And that's where interest rates have been historically low for the last couple of years, thanks to the Fed, right? Now with rates going higher, this is only going to cascade the problem. Then add on top of it the debt ceiling stupid discussion that Congress is putting us through. It just makes it all the more. Don't get me started on Congress and the debt ceiling. I hope people are aware that the veterans and the retired are paying the bills for this debt ceiling problem. Because when I got to say it, it bothers me. When the press talks about Janet Yellen is taking extraordinary measures to pay our bills, she's not funding government retirement programs.
Coming from somewhere.
That's where I think that's reprehensible. Congress doesn't do their job. We make the retirees pay.
Yeah. Well, guys, just to make you feel any better,
Tangent.
And in the time, no, it's okay. We love that. In the time that it took Bill to answer that question, the federal budget deficit increased by over $100,000. Just throwing it out there, just no big deal. Bill.
So that's the government having to pay more, but the other problem is the Fed's having to pay a lot more because there's two things going on here. For a lot of 30% of the treasuries that are out there, when the government's paying interest, they're paying it to the Fed. So the good news is the Fed is getting more interest income. The bad news is the Fed is also a huge borrower of money. We've talked about the repo market and the lending facilities. Right now the Fed is borrowed $5 trillion from the marketplace. And by raising short-term interest rates, they're now having to pay a lot more to borrow that money.
Mm-hmm.
So the Fed is actually losing now $1 billion a week as a result of them having raised interest rates that they themselves are now going to have to start paying.
Funny to think that this monopoly that you have over money, and all of a sudden you start losing. You should never be losing money in that situation. Well, tell me a little bit about this chart. You have a great graphic here, which is the Fed liabilities and remittances, or profitability. Walk us through that chart, because this one I look at, and as someone who stares at charts every single day in all asset classes, this would be one that grabbed my attention. It looked totally normal from 2010 all the way to 2022, and then
right, not a lot of volatility there, right? Now look at that. Yeah, no, this is interesting. So just to explain, as a result of the Dodd-Frank, I got to get nerdy on you for just a
Please
moment.
do, nerd out.
Nerd out. But as a result of the Dodd-Frank legislation, the Financial Reform Act, the Fed has to report audited quarterly financials, just like any other corporation. And I stress all too often with your folks that the Fed is not a part of our government. It's a corporation that has made money every year since it was created. So this corporation, though, having monetary policy responsibilities, is the corporation that destroys and creates money. So they have actually sucked in a lot of money. If you have a money market fund, for example, you have lent money to the Fed. Your money market fund has said to the Fed, hold on to our money. And the Fed right now is paying them a very attractive rate of return. That's why you and I are earning money on our money market funds. But that means the Fed, as they're raising short-term interest rates, is having to pay more and more to money market funds, more and more to banks. When banks can hold money at the Fed pays them for that. And that interest rate also is what they raised yesterday by 50 basis points. The rate they're paying us on money market funds, they raised by 50 basis points. So the Fed is acting almost in a self-destructive manner to do monetary policy. They're putting themselves in the position that they have to pay the marketplace more to borrow money. And we actually, on an operating basis, the Fed for the first time could lose money here. They actually, on a mark-to-market basis, they lost money last year because the Fed has the largest bond portfolio in the world, And as our yield curve shows us there that you were showing, yields went up over the last year. That means prices went down. So on a mark-to-mark basis, the Fed actually lost money last year, not on an operating basis. This year they could lose it on an operating basis.
It's crazy to think 1913 was the original, the creation of the Fed. So you're looking at 100 and, what are you, 2007, we're looking at 119 years? 109 years. Yeah, 109 years of profitability, and this will be their first losing year.
So what that chart is that I need to explain, I'm sorry, I went off to explain a tangent too much. What that chart specifically looks at is the net cash flows of the Fed. Because if you think about the way the Fed operates, it's like this multi-tiered octopus of cash flows coming in and out. Bonds they owe, bonds, trades they have to pay on. There's just all these multiple cash flows coming in that normally on a day-to-day basis balance each other out or hopefully show a slight net profit. What that chart is showing is what started this year. When you look at all these multiple cash flows, the aggregate of these cash flows is resulting in the Fed having to pay out huge amounts of money.
Mm-hmm.
I mean, literally $24 billion is the net of what they've paid out since August. That's what that chart is showing.
Crazy.
That's huge.
Yeah, it's a wild chart. I don't know if you can answer this question. I can't. I think this is above my understanding. I don't do anything with currency swap agreements. But Ganesh says, if many countries do trade through currency swap agreements, not in dollars, won't that exacerbate the U.S. debt crisis? I see debt at current is about $94,000 per citizen. Yes, it is $94,000 per citizen, but I don't know about currency swap agreements myself.
No, it really wouldn't, because again, it's a derivative transaction, so it doesn't actually increase the amount of debt out there. But as an interesting tangent to that, and that's a good question. Most people aren't usually aware of currency swaps. Our Fed is currently engaged in currency swaps with 16 other countries. During the pandemic, 16 countries reached out to our Fed and said, we'd like to do currency swaps for you, meaning we'll give you our local currency, you give us dollars. Because during this crisis, we'd rather hold on to dollars.
Mm-hmm.
Now, we during the Great Recession, we actually did that with 13 countries. We increased it to 16. But if you look on those trades too, because the dollar has gotten so strong that, there's going to be mark to mark on those trades too. Now, back in 2008, they made a pretty good profit on those trades. It looks like we'll be a net loser on these trades. But yeah, the Fed is engaged in currency swaps.
It's not just, you talk about the U.S. Fed losing. You've got another slide here which breaks down different central banks. So this isn't something that's unique to the U.S. system. You've got the Swiss National Bank, it says estimated losing about $143 billion. Bank of England, $200 billion worth of losses. Canada, $26 billion. And the ECB losses approximately $800 billion. As a trader, as someone who sits there and is trading on a regular basis, and I see losses in my account, I know that prolonged losses are going to be the thing that wipes me out and ultimately puts me in bankruptcy. Looking at the way the Fed operates, I know it's obviously not the same as an individual person, but I can't help but to think that if those losses continue and they become so profound, is there a magic bailout for these guys, or do they end up, blowing their accounts, if you will, like I would as a trader?
This is the stopgap of the system, and it's never been tested, I have to point out. But again, this weird relationship between the Fed and the government. I stress the Fed is not a part of the government. It's a for-profit corporation with shareholders. But there is a relationship with the government. So every year, the Fed turns over its profits to the Treasury. So it starts at the new year at zero, literally. Now, last year, the Fed made a profit of $859 billion. Which was the most they'd ever made, and they turned it over to the Treasury. Now we're talking about the Fed this year could operate at a physical loss. Now, in that case, because they're the Fed, what they get to do that you and I can't do legally is they can cover those losses by literally creating money. They got to stop it.
I wish I could.
I know, we could, but we get in trouble. You and I, so the Fed literally can offer AA rated quality backing because ultimately they can print money, and they, as we know, they do.
Last time you were on, obviously there's the Fed funds rate. That's the primary thing that changed yesterday. But you mentioned that there were some interbank lending rates that had changed, and maybe some of the repo numbers. Was there anything else that was a headline number that changed? Because to me, I feel like I only saw the Fed funds number change, not all this other stuff. But you look at all the other details of what has changed.
Yeah, and here again, I have to confess, this was a boring announcement because again, it was 25 basis points. That was a yawn. The market was expecting that. But the market also on the other three rates that the Fed could change, they did, and they did exactly the same 25 basis points. So just maybe to tick through them real quick. So we've got the Fed funds rate. That's the rate that banks borrow from each other, but the Fed sets that rate, or they set a range for that rate. So that's the interbank rate. They also adjusted by upward 25 basis points the discount rate. That's the rate that banks can borrow from the Fed, right? The Fed is the lender of last resort. You borrow from the Fed, they charge you for that. And that rate was also jacked up by a quarter point. Now, the Fed, third rate is the Fed also pays banks to literally just hold their money. The Fed's trying to suck cash out of the system, and they're doing a good job, I got to point out. I'll come back to that. But the Fed has literally said to the Fed has said to the banks during the pandemic, just let us hold on to your money, do nothing with it, and we'll pay you a very attractive rate of interest. So that's the third rate that they jacked up by another quarter point. And by the way, last night we had over $2.5 trillion. Sorry, billion here, trillion there. $2.5 trillion worth of money was lent by the banks to the Fed just to hold on to it to enjoy that high interest rate. And then the fourth interest rate the Fed jacked up yesterday was the repo rate that they do with money managers such as BlackRock and other large asset managers. So that's where you're getting a much better rate than you were a year ago on your money market fund, because so many asset managers are turning their money over to the Fed, letting them hold on to it and pay them a pretty attractive rate. That account also is doing over $2.5 trillion every night. So the Fed's actually doing a pretty good job of sucking money out of our economy. That's the cause of inflation traditionally. But the problem is it's costing them a lot to do that, literally costing them a lot.
Oh, wow. I'm going to comment on this. One quick comment here. This is from Lori. Says, I wish the government had to be like all of us and not spend more than they take in. It's a catch-22 because y'all love, indirectly, you all love the fact that government spends way more money than they have because that helps fuel the economy. That helps things grow. If the government was living within its means, we probably wouldn't have some of the qualities of life that we do. I think that, them spending recklessly does help. It helps the equity markets. It helps jobs. So those things are great when things are roaring in our favor. But as always, we're going to have this ebb and flow. I was thinking, talking to a friend of mine about this the other day. It's kind of like, let's say you've got three average workers, right? They're making an average salary, no big deal. And you got that one rich friend who's always just like buying you stuff all the time. You love having that guy around because, hey, I wasn't going to buy a bottle of Dom Perignon, but you're going to be making it rain over here. Bring it on, great. But all of a sudden, that guy is no longer fueling the fire, if you will, and you're now set in your ways. You're expecting to go out to nice restaurants and have him pay for everything. Well, it's kind of that same way with, at least that's how I perceive our current market situation. We've had the government and just reckless spending just to keep things afloat and keep everybody somewhat happy and, hey, we're doing okay. If it didn't happen, right? If we did not have some sort of stimulus during the COVID thing or bailouts during the financial crisis and bailing out Bear Stearns and Lehman Brothers and these types of firms, we would be in a much darker place. It would be much harder to get out of, but once you got out of it, I think the system would actually be better because it would self-heal as opposed to having all this artificial stimulation to help it heal. So, I'm kind of torn with you, Lori. Like, I agree. I wish that they had to do what we do, which is live within our budget, live within your means, don't overdo it, watch your spending. But then again, you love it because the growth that we experience in our portfolios and just price appreciation of housing is directly related to spending and spending and spending. Anyway, my little rant for the day, Bill.
I'm with you. Everything I parrot you. I share exactly your sentiment there.
Nice. So what's your forecast? I mean, I think right now, based off what Jerome Powell said, he said a couple of more hikes. I like that he said the word couple. He didn't say a few or several or many or ongoing. He said a couple of more hikes. He did say ongoing increases are appropriate. What's your thought for their path? I mean, you've seen this action before. You've seen kind of how the Fed acts. What's the remainder of the year look like if you had to be on the Federal Reserve's board right now?
Yeah, no, that's a great question. And again, I have to preface it by saying I'm a bond guy. I have to go by what I've experienced in history. And I do think that the actions of the Fed are going to push us into a recession. which means we're going to have a further steepening of the yield curve because the Fed will continue briefly to continue a couple meetings. But more importantly, once we get the acknowledgement of a recession, that puts the deflationary pressures to the long end. So long-term rates are going to go down. I really thought personally that rates, we still had more inflation ahead of us. I really thought we could see long rates go back up to 4.5%, kind of the highs of where we were, because I see some systemic issues, not just the fluctuations of energy and food. But be that as it may, it looks like perhaps we are going into a deflationary period, and that's going to bring long rates down. So we've got this further inversion of the yield curve ahead of us. And I think the bond market will be right for the 8th time. We've had 7 inverted yield curves, led to 7 recessions. I think the 8th one is pretty well signaling the recession. And I'm not going to bet against the bond market. I'm really not.
Yeah, I don't know which one's worse to bet against, the bond market or bet against the Fed. Those are both difficult counterparts to take the opposite side of the trade on. For the viewers out at home, I've got the 10-year up right now, just so you can see. We built that little channel in there just to kind of outline that, it was screaming towards that 450 mark for the 10-year, and now you're just slowly drifting down in the channel, currently trading at about 3.4%. Here is your 30-year, which is currently at 3.5%, so pretty much flat with the 10, but also well off of its highs, which was close to, was right around 4.4%. And, we haven't seen it tank. It's not like the yields are declining aggressively, especially with the 30 kind of holding right now. But if the current trend is any indication, we'll wait for the break below these lows of 3.4% on that 30-year and then continue to drift lower, which means those bond prices will be increasing and yields dropping. So.
And I would point out for people looking at mortgages, the mortgage market benchmarks itself to the 10-year.
Yep.
So more as the 10-year has come down from 4.5 down to 3.4 and looks like maybe even drifting lower, that's good news for mortgage rates.
Yeah, we did see the most recent housing numbers were showing an uptick in pending home sales, existing home sales. Even the one that really kind of surprised me was the new home sales numbers. That came out much higher. And we actually just, not a special, but I had a comment on that one, like, how are these home builders doing so well? And they're not just building the McMansions anymore. They're building giant apartment complexes, luxury living, if you will. So.
Right. So mortgage rates are going to help us there.
Absolutely. Cheap money helps fuel the markets. Tell me about your upcoming schedule. I know you and I, Larry, Todd, Jordan Matthews are going to be doing a special event for OTA on the 14th, Valentine's Day. So we'll all give each other virtual hugs through Skype, I guess. But you've got that presentation on the 14th.
Not the group I was expecting to spend Valentine's Day with, Merlin. When I look at that group, not who I was expecting to spend Valentine's Day with.
Yeah, I mean, come on, we're just a happy group of guys.
Yes, we are.
Can we get some lady traders out there? Come on, let's do.
Really?
So, what's your teaching schedule look like? What's on your plate?
Yeah, no, we've got that program on the 14th. That kind of 3-hour symposium. I'm looking forward to that. We've got the XLT. I'm going to be on February 28th, literally at the end of the month. But for that one, what we're going to focus on, I should mention briefly, for the last 3 years, like most people, I couldn't find a reason to buy bonds. Yields were so abysmally low thanks to the Fed. Now, though, as we showed you on that chart, interest rates having come up, but also the credit spreads on corporate bonds, the yield premium that corporate bonds are offering on top of that is even widening out once again to pre-pandemic levels. So we're actually getting to the point where we can start talking about bonds for income and safety purposes. Old strategies like ladders and things like that. So we're going to talk about bonds not as a trading vehicle, but bonds as an income vehicle, because we're starting to get some yields. 6% for a 2-year corporate bond, that might be worth looking at again.
Yeah,
and I've been able to say that for a long time. So that's going to be an XLT on February 28th. And then we also have soon to drop on Larry's desk the outline and final draft for my focus class. We are going to be offering a 1-day focus class, and that class is going to focus more on bonds for trading purposes. Bonds, ETFs, and duration and volatility and all that fun stuff that your audience likes. So we'll be addressing the more trading-oriented side of bonds for the focus class, and hope to get that out by March. We really got to get that to you guys.
Good. Well, I will be. I'm waiting for that class, and I'll be certainly happy to promote that one. As I love all your education out there, so appreciate you taking some time out of your schedule to come on and share some thoughts on the bond market today, and of course, what happened with the Fed. And are you still teaching for them? You got some Fed classes coming up?
Yeah, we've got contracted 2 classes. I'll be doing one for the summer for their new hires, their associate program, and one of them later in the summer for their veterans program. They do a separate track for veterans. So I'm going to be teaching at the Fed twice this summer. So my summer schedule of the institutional clients builds up, but that's why I'd like to get these focus series out to the OTA community before my summer goes crazy. So
while you can,
yes,
get them while they're hot.
looking good. That's it. Looking good.
All right, Bill. Hey,
always a pleasure.
Always a pleasure. Thank you so much. Have a fantastic remainder of your day, Bill. I'll talk to you soon. I'll see you on the 14th.
See you then. Looking forward to it. Be well, all.
Bye-bye.
Bye now.
Guys, Bill Addiss of AF. Actually, I didn't even plug his site. That's really just not cool of me. I guess I should give him a little props out there. It is AFT Training. Here is the website. I'll bring that one up. I think I had it all ready to go. I just didn't get a chance to talk about it. He has some YouTube videos as well. Here is the Amherst Financial Training. It's aftraining.co. He's got some videos on there, links to his YouTube channel as well under the media page, so you can click on there. And I think this may even give you the graphic that I used for today, which was, I actually took this picture and I put it into, there it is. That's the picture I used. I took that into my AI program, and that's what created, this is what AI took that picture and made that one. I think that the AI generated one is even better. Love it. Anyway, so as I got the ladies in the crowd getting all worked up, no, I didn't mean that in a negative way. It's just the presentation that we're giving for OTA on the 14th. Seems like it's all guys. Let's get some ladies in there. Let's get some lady traders. I know we've got a whole group of them in here. I love it. Maybe you guys should start teaching some classes for OTA. We'll get you on some of these, what was it called? Not a symposium presentation. Anyway, let me go into our current markets. We'll steer away from bonds right now and move into the equity market side of things. I'm going to run through real quickly the macroeconomic pieces. We'll look at earnings and then show you what's going crazy in the current market for the NASDAQ. As you can see here, no real surprises with regards to the main refinance rate for the euro. That came in line with expectations. Same thing for the Bank of England. They were expected to have 3.5%. They were at 3.5% and expecting it to jump to 4%. Lo and behold, we got exactly those numbers, and those markets didn't have overly dramatic responses. Here is the chart of the British pound on its reaction, and I can zoom out here till, say, a 15-minute time frame. You can see when that announcement happened, it surged up but gave it all back. And when you look at the euro, you have a similar picture. This is actually the Fed announcement, so excuse me. This here in the morning part is when that announcement came out. So not looking so great on reaction to those rate increases. They were expected, but the real fun stuff is right here. And that is the earnings. You saw yesterday Facebook beat earnings and did a share buyback of $40 billion, laid off 11,000 people, and boom, up 20% today. But Facebook Meta isn't the big driver. The driver is Apple. Apple, Microsoft, and Google are the top three there. Now, if you look at it, you can see Apple at the very top there, expected $1.93. I thought that was a bit lofty when we looked at it on Monday. Came out honestly, a lot higher than I thought. It came out at $1.88. So they missed earnings by 5 cents, which was a 2.5% miss. Down 3.9%. We'll look at it here in just a second. Amazon, they beat earnings by 6 cents, and they were down 5%. Ford missed earnings by 9 cents. They're down 5%. Google missed earnings by almost 8%, and they were down almost 4%. So the big names out there tanking, and I will show you the charts here right now so we can dive into those. Let's start off with Apple, the big daddy. Actually ripping back up at least a little bit. It was down much more. Let me give you the exact percentage here so we can see. So go to the why does my chart look like that? That's kind of weird. Oh, because I have a big yellow box around it, right? Huh, that was weird. Strange numbers. Anyway, from where we closed to the dead low at one point, it's down 5.7%. It shows to me down 1.62 right now. So not that bad, starting to claw back a little bit. Knowing the way these markets work, all of a sudden you could see the markets gap up tomorrow. But that was your big daddy. Of course, if it's down 1.5%, that's going to have a weighing on the NASDAQ tomorrow morning. But what about Google? So here's Google's. They are currently down 5.17%. Notice no real bounce there. And then lastly, Amazon, who on the day beat earnings and is still down about 2.49%. So markets were rejoicing. I mean, Amazon was up 7% today. Just a ridiculous screamer of a day, honestly. I will start here and work our way from the bottom to the top. Based off of current numbers right now, this is not from the market close. This is as of right now. Here's your Amazon chart, and you can see that it gapped up this morning, just had a continuing run. That's because of Meta, right? Meta just vaulted everything on that NASDAQ. Again, 7% run today to 112. I'm kicking myself for getting out of my call positions. I bought 80 call. Was it 40 or 80? I forget. It was a lot of calls and had a huge gain back here, and I didn't hold them. I really wish I would have. Anyway, shoulda, coulda, woulda doesn't make a difference now. As far as Amazon goes, there aren't any really good supply zones where we are at presently. Probably about 120 is where you're going to see that next one, but it's already down from those levels. Now, let's start from the bottom, work our way up with crude oil. Crude oil continuing its slide. That overhead supply, I was actually feeling rather positive because it felt like it was chopping away in that yellow box area, eating away some of that supply. But lo and behold, we've had 4 out of the last 5 days have been pretty aggressive down days. Probably going to see that trend continue here just because that is what the trend is from that break. Down 0.69% today. Gold as well showing a little bit of decline. 1930 is where we're trading at for gold, down $12 or 0.62%. Again, I'm going to keep this line at 1876 because it just feels like it's wanting to pull back to that level, but I still am bullish on gold to 2000. Dow was down 0.15%. That's probably due to after hours trading as well. But again, it's a non-event because the Dow was simply sitting inside of sideways consolidation. No real exciting thing to talk about there. And if Tom is here, hey Tom, this is starting to look like that Russell did a couple years back. Remember, we had the Russell was in a sideways channel for like 15 months. It was ridiculous and just a great breadwinner. This may turn out to be one like that, where you have just perfectly sideways action, price staying within the range. Great. Might want to look at trading some of them Dow futures or Dow ETFs. Bitcoin, 1.05%. Good news is we tapped above 24,000. It is above 24,000 as we speak. Bad news, still a lot of uncertainty and lawsuits going through with FTX, with Genesis and Gemini and Digital Capital Group. I mean, there's a lot of dangerous things happening in the crypto space, which could put some downward pressure. But the good news is a lot of these crypto markets have been accelerating and showing some nice trends here. I've got that 24,000 mapped out because that's this area that it peaked out at back in August of 2022. Now, if that breaks, I don't know why I have this 27.8 level mapped, probably because it was demand. But I would really be more inclined to think we're going to get up to that 32,000 level. But I expect chop this year. I did not expect to see a big run in crypto. How about that inverted yield curve? Let's go S&P 500, top 3 for today. This one smoked to the upside. Notice 4,200, a huge psychological number for the S&P. 4,200 is a number that comes up over and over again, and that was the last time, we had a pretty aggressive sell-off from that point. Today we ran smack into 4,200 on the S&P before pulling back just a little bit. It was up 1.43%, and that's your third place finisher. Taking the silver medal today, Russell 2000. We talked about it breaking these highs at 1926 and challenging those highs at the top of the yellow box, which is right around 2040. And lo and behold, we're almost right back up there. It's 2007 is the price for the Russell 2000 right now, very close to that target of 2040, or just a hair shy of 2040. It's actually, if I go to the peak there, it's right around 2030. So you've got 23 points left. It moved 39 today, so it could easily get there in one day. But with a move like this coming into supply, expect there to be a little bit of a pullback here, a relief pause, if you will. Finally, the big daddy, thank you to Meta and the tech giants, ripping through not only these established zones, which I can get rid of that yellow box now, but coming right back into 12,800, which was the last, again, area where it had a pretty big sell-off. For this reason, I did buy some puts today. I bought the April puts for the NASDAQ 100 ETF, the triple Qs. Now, I don't plan on holding them that long. I think you'll probably see a little bit of a pullback here. With this NASDAQ 100, the earnings today, Apple, Google, and Amazon, I think might start off tomorrow with a fairly negative approach. Right now, it's down almost 1% presently in the after-hour session, and that could extend. We'll have to see what the response is in the morning, but I'm expecting a pullback on this one, and we'll have to wait and see how it all pans out. But the nice gap and go today ran right into overhead supply for the NASDAQ 100, and that is pretty much it. Now, the one that did not do me any justice, and I doubt I will probably get executed tomorrow, is natural gas. Natural gas was not looking very good today. We fell even more. It was 0.49%, but look what happened intraday. It was trying to get its feet back on the ground. It was doing great, and all of a sudden, right around 9:40 in the morning, it just fell apart again. It just cannot seem to get some legs underneath it. I feel like the short squeeze is coming here on natural gas any day now, which is why I'm okay holding long natural gas. I know it's nuts. Now, my trade right now, I'm underwater, and pretty good underwater, by the way. My strike price was 7. My premium I collected was 40 cents on that bad boy, which makes my average price 660. So right now I'm down 50 cents on 10,000 shares. So that's going to be about I'm underwater $5,000 on this one. But we'll have to see what happens as of Friday. I'm not too worried about it because the premium, if I were to sell the $7 strikes right now, I could probably get 50 cents as well. So the premium is just off the charts on natural gas, but we'll wait and see what happens at the end of close tomorrow. I don't think it's going to get above my strike price at $7, which means I will probably exercise. And on Monday, we'll have to do some little bit of damage control on my natural gas and oil. Anyway, let's go to your economic calendar for mañana. It's going to be Friday, which means I have a total open Q&A day. So for anybody who wants some questions answered, put them down below any of the YouTube videos. I didn't get to any questions today because time is running here and I have just, again, as always, a million things going on. So I'm going to try to wrap this one up. But if you have questions, put them down below any YouTube video. I see all those questions come through, and I will get to them on tomorrow's show with a glass of whiskey, of course, regardless of what happens with my oil natural gas trade. Here's your economic calendar for mañana. As you look through this one, it's all services numbers from Italy, from France, from Germany, Spain, and then ultimately the EU as a whole. They also have PPI numbers coming out for the EU. And then down near the bottom, 5:30 in the morning, which is 1 hour before the equity markets open in the United States, or in the Pacific Coast, you have average hourly earnings, unemployment rate change, and non-farm employment change, and unemployment rate. They're expecting that unemployment rate to pop from 3.5% to 3.6%, which is still ridiculously low. And we'll see if it comes out any higher than that and creates more waves for your Friday. If it does, the negative pressure from, why don't you roll? Roll what? Nah, I'm not. I'd rather take hold of it. I'm fine owning it. I do think you're going to see a squeeze and a bounce here, but if we do see a really bad unemployment number, that could change the trajectory of this market. And it just feels like there's a lot of variables that could be lining up for a pretty negative day tomorrow. So I'm okay with the equity market play, and hopefully my Q trade will offset my my loss, on at least paper loss on oil. All right, that's going to do it for me. If you guys enjoyed today's show, do me a favor, give me a little thumbs up, hit that like button. If you are brand new, hit that subscribe button. I've noticed we've got a lot more people, some random names that don't normally join in chat. You guys should definitely start joining on chat, engage. We got a fun group here. Just keep it clean, keep it safe. Don't be throwing nasty comments or insulting people, because I will block you and remove you from chat. Don't be trying to spam your porn sites as we get here every now and again. I'm usually pretty good about blocking that stuff, but yeah, love having you guys in here. All the chat's good. What are we looking at now since the curve refuses to return to normal? It will return, Steel Stocksman. It will. I mean, it's just a matter of time. It's just how long, what's the damage of that inverted yield curve being inverted for so long, right? How damaging is that? I don't know. I've been a part of multiple inverted yield curves, but nothing that's been this long. To me, kind of a dangerous one. Okay, I won't discuss your question tomorrow, Lisa. No problem. All right, cool. Excellent. Well, that's going to do it for me. If you guys have questions, again, put them down below YouTube videos. That's the easy way. Or you can email me at TraderMerlin@gmail.com. I'll incorporate those into tomorrow's presentation. Have a nice frosty glass of whiskey, and I will see you all tomorrow. Take care, everybody. And again, if you like Bill Addiss, I would encourage you, sign up for the OTA symposium on the 14th. That's going to be a whole bunch of us. I'll get you more information on that one tomorrow. He also has an XLT on February 28th, which I would encourage you to check out. Take care, everybody. Have a great night. I will see you tomorrow for the Market Mayhem Roundup on Friday.